Good afternoon, everybody, and thank you for joining us on this webinar. My name is Lisa Vicidi, and I direct the Energy, Climate Change, and Extractive Industries program at the Inter-American Dialogue. First, I want to thank Holland & Knight and Columbia University's Center on Global Energy Policy for partnering with us on this event. Today, we'll focus on two major events that have rocked global energy markets recently and their impact on Latin America. A failed OPEC Plus deal to cut oil supply on March 6th resulted in a decision to ramp up production by two of the world's largest producers, Saudi Arabia and Russia. Meanwhile, the spread of the novel coronavirus has slowed growth in economies around the world as precautionary measures have been put in place to combat the virus, further eroding demand for oil in an already oversupplied market. As a result, prices have plummeted below $30 a barrel. In Latin America, low crude prices have immediate consequences on public coffers in the region's oil-dependent economies. Many governments in the region depend heavily on oil revenues and had budgeted oil prices that are well above today's prices. International oil prices are also well below break-even prices in many countries in the region, in basins such as Brazil's deepwater pre-salt and Argentina's shale. And both national oil companies and oil majors are capital constrained because of lower prices. In the electricity sector, demand is declining amid the economic contraction, and governments may delay long-term renewable energy auctions. Supply chain disruptions could cause project delays, and investors are fleeing emerging markets to invest in safer assets, which could also make financing renewable energy projects more difficult. Natural gas prices have also plummeted, making them more competitive against renewables for new builds. Energy markets in Latin America will face challenges for as long as low prices and COVID-19 persist, and will likely to continue to see after effects even once the storm has passed. Today, I'll ask our panelists to talk about the specific impacts for Latin America. You can also go to our energy program page of our website to see an analysis I recently published with my colleague Nate Graham on the impacts of the price decline and coronavirus on the oil and power sectors in Latin America. With that, let me introduce today's panelists. Mauricio Cárdenas is a visiting senior research scholar at Columbia University's Center on Global Energy Policy, and he's a former finance and energy minister of Colombia. Jose Vicente Zapata is a partner at Holland & Knight law firm in Bogota, Colombia. Camila Ramos is the managing director at Clean Energy Latin America, a consulting and financial advisory firm based in Brazil. I'd like to ask each of you a couple of questions to start. So Mauricio, let's start with you. Several countries in the region, as I said, are dependent on oil revenues for significant shares of their government spending. Which countries do you think will experience the largest impacts of low oil prices, and what will that mean for their economies?
Well, thank you, Lisa. First of all, hello from Bogota, Colombia, where we're in our second week of a complete lockdown. I hope you're all in good health and your families and friends as well. That's the most important part of everything now. So this has been a tremendous shock for Latin America because it's not just the direct effect of the coronavirus. It has come with two additional consequences or channels, if you wish. One, the decline in oil prices and other commodity prices, but mostly oil. Some minerals have also fallen. And two, the turbulence and turmoil in global financial markets. That for many countries in Latin America means higher spreads on the sovereign debt. So it is a situation that does not resemble anything I have seen throughout my life, this combination of shocks. Which are the countries that are more likely to be adversely hit by this? If we just look at oil prices, disregarding for a moment the issue of the coronavirus and the issue of access to international financial markets that make things worse for some countries, just on the oil front, the number one country that is going to be impacted is Venezuela, because it's the more oil dependent in terms of the economy, in terms of the balance of payments, in terms of the fiscal accounts. So what this means for Venezuela is that there'll be another decline in oil production. Keep in mind that sanctions to Venezuela were in place before the decline in oil prices. Sanctions to Rosneft as well, increased and adopted in February. So most likely Venezuela will not be able to sell the oil it was selling in the past, especially to India. And this means that there'll be significantly more cash restrictions in Venezuela. Add to that the effect of remittances from Venezuelans working abroad, and this means that the situation is going to be, it was a really bad situation, it's going to get even worse. Second in line is Ecuador. Ecuador produces about 500,000 barrels of oil per day. Its fiscal accounts depend heavily on oil. A $10 decline in oil prices represents a 1% of GDP loss in fiscal revenues. At the time when Ecuador is trying to comply with an IMF program that forces a fiscal adjustment. That means that unless there is some flexibility from the IMF, there is no space for a fiscal stimulus that is much needed at this time, precisely because Ecuador has been one of the countries in South America most affected by coronavirus. It has more cases, has twice the number of cases that Colombia has, a country that is 1/3 the size of Colombia. So it's a very difficult situation for Ecuador. Next in line, I would say, from a fiscal point of view, Mexico, Colombia, and Brazil are in a relatively similar situation. They all lose fiscal revenues, say with these declining oil prices that we're seeing until now. Budgets were made with prices around $60 per barrel, and the price today is around 20. So a $40 decline relative to the budget means that these countries are losing between 2 and 2.5% of GDP in fiscal revenues. Situation is very difficult for Mexico, but particularly for Pemex, because the government of Mexico has always been using a very sophisticated hedging strategy. People say that the hedge was at $49 per barrel for this year. So the government of Mexico will not see the consequences this year. We'll see the consequences next year if prices remain low. But Pemex is not as hedged as the government of Mexico. So Pemex is going to lose cash. That's going to affect, well, it has already affected the credit rating. It was downgraded last week by S&P, and it's going to affect the capex of Pemex. And Pemex will require even greater transfers from the government of Mexico, especially if it continues with projects in the downstream business, like the Dos Bocas refinery. I'll make a final point about Argentina, which also produces about 500,000 barrels per day, but it is not as fiscally dependent as the other countries because Argentina also imports oil. The oil does not make a significant contribution to the fiscal accounts. So this is not really going to have an effect on the ability of Argentina to meet its fiscal targets. Also under an IMF program, Argentina will be put under pressure for other reasons, mostly because of the declining other commodity prices like soybeans. So that's more or less the landscape in terms of the magnitude of all this from a fiscal standpoint. As you can see, all these countries will be losing revenues at a time where coronavirus calls for large stimulus packages. So which are the countries going to be able to do that? Well, the ones that have access to international financing, the ones that can actually have a higher deficit and can actually finance that in a sustainable way. Among those countries, Colombia seems to be in a good position, and Colombia has already announced a significant fiscal package to fight coronavirus. The other two countries in the region that are gainers because of the decline in oil prices are Peru and Chile, and not surprisingly are the countries that are putting forward the largest fiscal stimulus because they actually do have more fiscal space than the others. So that's, I guess, my answer to the overall picture on how these maps from declining oil prices to fiscal accounts.
And going back to Venezuela, I mean, the situation there is incredible because the country actually, they have very low production costs. They have, the average production cost is about $14 to $18 a barrel. And in some places, it's even, in certain fields, it's as low as $5 a barrel. But they're having, as you mentioned, they're under sanctions. They were already having trouble finding buyers. So now they're having to offer very heavy discounts. So what's your sense of, you know, this is a country, I think, where we could expect to see a real decline in production and a decline in, you know, development of new fields. What's your sense of how, in the longer term, as oil prices that are low persist, how is this going to affect future investments? So, you know, you explained that like immediately it affects public revenue as every barrel is sold for less. What about investment, which is, could be longer term? You know, which do you think we're going to see a drop in exploration and production investment? Which countries do you think, or which types of resources do you think will be more affected?
Sure. Let me answer that, and I'll come back to Venezuela at the end. So this is going to affect investment everywhere in the world. I mean, it's already affecting investment and the capex budgets in the U.S. In shale in particular. People are talking about 35% decline in capex already announced by companies. So this is going to be the same in Latin America. I mean, Petrobras already announced a 30% cut to its capex. Ecopetrol about 25% cut in its capex. And the companies operating in Vaca Muerta in Argentina are going to cut their capex as well. So what this means is that the prospects for an increase in oil production in Latin America are now looking grim. I mean, they don't look as they did last year. It's this region was going to add to global oil production about 1 million barrels between now and 2025. I think that's now very questionable. I don't think that's going to happen. On the contrary, we're going to see cuts in production. So Brazil is going to cut production by about 100,000 barrels this year. Colombia's production is going to fall as well. Keep in mind that Colombia's average cost is about $30 per barrel. So with current prices, it wouldn't be surprising to see that some of the production is shut down. And the same in other countries, including Venezuela, of course, where the cut in production is going to be much higher for the reasons you just said, which is that they were selling oil at huge discounts, and with the current prices, production is just not economical. Plus the fact that some of the buyers that were circumventing the sanctions, like India, for example, will not be able to do that now. I mean, with the increased sanctions adopted to Rosneft in February. So what this means that there'll be less production coming out of Latin America, which is minor in terms of the numbers compared to the necessary cuts at the global level to balance supply and demand. But it's a trend that would affect these economies as well, because oil production accounts for a significant share of GDP. Well, certainly in Venezuela, in Ecuador, double-digit numbers. In Colombia, about 5%. In Brazil, about 3% of GDP. But this will add to the overall economic contraction in the region that is being caused by the coronavirus, because remember, coronavirus and the lockdowns are affecting not just daily lives, but also the economic indicators. Just to have a metric of this, the demand for electricity in a country like Colombia during the lockdown days has fallen by about 15%. That's just a proxy or a leading indicator of what can happen to GDP this quarter. So it's a significant decline in economic activity, and oil production will just add to that.
Right, and we are also going to talk about electricity, the electricity sector and the impacts. And I think, as you point out, both the national oil companies and the oil majors have constraints on capital because they're receiving less revenue because of lower prices. Now, I think, you know, the large deep water projects that are already up and running are obviously not going to be shut down. But I think the future projects, as well as shorter term investments like shale in the region like Argentina, could definitely be affected. Let's move on, and we'll come back to some of the other questions related to the oil sector. Let's go to Jose. So you've been looking at this, of course, Holland and Knight, from a legal and regulatory perspective. So how are cross-border energy investments and trade, how are you seeing them affected by coronavirus?
Thanks, Lisa. And again, I share Mauricio's view on hoping everybody is safe and keeping safe. With respect to what we're seeing from a legal perspective, I think that that's something that I'd like to highlight, which is particular for the realm of law, is that one has to be able to differentiate the COVID situation from the oil and gas price situation. And this is particularly important when we're looking at prices. Today I was looking at Brent, $24.98, and WTI, $20.42. And when you look at that, there has to be a legal manner in which one addresses in a different manner the situation associated with COVID and the situation associated with the oil and gas prices. And the reason for that is because from a regulatory, from a contractual, from a case law perspective, one has to address these two subject matters, which today we're facing at the same time, simultaneously. We have to be able to find appropriate legal solutions to them while they not necessarily share the same components of a solution from a legal perspective. So I will be referring to the force majeure situation in a minute, but when you look at this, at the end of the day, COVID can be rapidly introduced as a force majeure discussion, while the oil and gas prices, this debate is a bit different from a force majeure discussion. Now, the problem is that one has been compounding upon the other from a regulatory perspective. So the first thing I would say with respect to your question is that the manner in which one addresses the impacts on cross-border investments and trade with respect to this particular situation has to find different approaches to one and the other, despite the fact that they both jointly are impacting the economy as we stand currently. Now, having said that, each country has been facing a different scenario from a cross-border perspective. And I would say that we've been looking at Ecuador, we've been looking at Colombia, we've been looking at Mexico, we've been looking at Panama, Peru. And when you look at other different jurisdictions from a regulatory perspective, then each country or sets of countries have been finding different sets of solutions to the problems that both of these issues present from a cross-border investment perspective. So you'll see countries like Colombia and Peru, which are very much aligned from a regulatory perspective as to how to try to balance investor protection, respect for the rule of law in a situation as COVID and dropping oil and prices and gas prices, while you see other jurisdictions such as Mexico, where only recently you start to see rules kick in with respect to more sanitary issues rather than oil and gas, energy matters from a regulatory perspective. And that rule of law will be providing solutions on the cross-border situation itself. In addition to that, I would say that from a cross-border investment perspective, there's something that is particularly important, and I think that we can highlight for this event. And that is what I would call, from a strategic perspective, on that negative impact on cross-border investment, which is not only a negative impact within or outside of the region into the region, but also within the regions. Many multinational Latin American companies are revisiting their investments within the region because of the simultaneous situations that are being presented, COVID and oil and gas prices. And when you look at those situations, there's something that I would call the conflicting strategic assessment with respect to what will happen vis-a-vis energy and renewables from a cross-border investment perspective. And what you see there is that you have the upstream, you have the midstream, and you have the downstream players sort of in a conflicting scenario simultaneously with public utilities, which have a conflict with them supplying certain gas, certain oil, and certain services. And then in addition to that, with the need to ensure that all of these services simultaneously stay in place, and that the projects associated with renewable energies into the future can be maintained. Because funding for those projects, as Mauricio was also indicating, is a key element of those renewable energy projects. So at the end of the day, we're in a very interesting scenario where one could easily say, well, this cross-border reduction this cross-border impact should, in fact, because of the oil and gas prices and the dependency on oil and gas prices, that this should react immediately, promoting renewable energies. But it's not that easy, because for those renewable energies to be developed appropriately, then what happens is you have to be able to consider the full picture of financing, the full picture of how oil and gas prices were determining the future of those prices, those projects, and in turn, how COVID and the shutdown itself generalized is affecting the development of projects. So when you ask the question of how are cross-border investments being affected, at the end of the day, what you see is a combination of factors which are still to be defined in a more paused, in a more calm scenario. So right now we're seeing regulations, we're seeing decisions, we're seeing how all this ties together and how it evolves, but we haven't seen, of course, where it leads us and where we will be tomorrow, simply because of the fact that from a regulatory, contractual, and from a force majeure and case law perspective, you know, when you look at that package, then you say, this really is impacting cross-border investments, but where the tide settles, where the tide becomes more stable, is still to be seen from a legal perspective. So right now, that is what we're looking at, and I'll turn it over to you, Lisa.
Okay, yes. Can you sort of give us a sense of like the scope of the problem? I mean, there are supply chain disruptions, there are companies that can't get parts that they need. There are situations where, you know, demand might be very much lower than expected, and that could affect different, you know, that could affect starting with distributors, but then also affect generation. So you're affecting different kind of all different levels of the value chain, and in many different countries. I mean, could you give us a sense of the scope of how much of this you're seeing, and are you seeing more problems with certain types of infrastructure, you know, pipelines? Are you seeing more in renewables? Are you seeing more in oil projects? You know, where are you seeing more force majeure being declared? Certain countries, you know, sort of where do you see the main problems, and what's your sense of the scope of the problem?
Yeah, that's a great question. What I would say is, and a good example for that, you know, is something that we're facing throughout the region, which is the price of oil and gas vis-a-vis the net back value that upstream players are defining or have defined historically, vis-a-vis, for instance, take-or-pay contracts or similar contractual relationships in the transport of that oil and that gas. So if you look at it in a simple example, and if I were to say the upstream player is seeing the price of oil and gas drop, therefore the cost of transportation for that player has increased in the sense that it sees that value as hitting its netbacks in a much more significant manner. But then at the same time, at the end of the tube, you have the consumers, whether they're industrial or not, wanting to make sure that the prices are balanced with the current situation. And how do you transfer that price value to the final consumer? In that scenario, I think that the critical, and that was what I was referring to as the strategic assessment, you know, one of the key issues throughout Latin America, and I think worldwide, is being able to find the appropriate equilibrium between that formula. Because what has happened reactively from a legal standpoint is that everybody has asked the same question: are we all in force majeure? And to a certain degree, if we're all in force majeure, then at the end of the day, nobody's in force majeure, because if you stopped everybody, then nothing would be moving forward. So how do I fit in the regulations in some countries, which is what we're seeing, that say you can't drop these prices? The prices will be controlled, with regulations in other countries which say it's the market that's going to define the situation. And where each player within the marketplace, from a regulatory perspective, from all those contracts that were long-term contracts in the marketplace, how are you going to address these situations so that it's not one of the sides pulling further or going further than the other sides? That equilibrium is something essential. When you look at all that from an oil and gas perspective and turn it into the energy matrix, then what happens from a very important perspective is, you know, people ask, well, this should motivate, again, that we should be promoting more renewable energy sources because this is precisely the problem that we want to avoid. But when you look at it, at the end of the day, a simple example is electric cars. The World Energy Agency has been, International Energy Agency has been indicating that sales have been going down. They will continue to go down. People are not buying certain things that are required for those renewable energy sources. Mining has gone down, which it provides specific minerals for renewable energy sources. So everything is significantly tied together, and that is sort of what is happening in the region. Right now, we're in that tidal wave coming into town, and we're trying to address it. But I think that the more balanced we can react and the more we can assess these matters from a legal perspective in a calm way, the more the market will be able to find a new equilibrium with respect to these cross-border negative impacts.
Wow, it's an incredible situation. Well, I think we have some questions I see coming from the audience related to that, but let me go to Camila and then we'll come back to some of these issues so we can answer the specific questions. So Camila, you're coming to us from Brazil, and you're going to talk specifically about what you see in the Brazilian market. And I think, you know, Brazil is the largest market, so it's obviously extremely important. And I think also some of the things you're seeing are certainly, surely happening in other countries in the region. So, so first of all, you know, how is power demand being affected in Brazil? Mauricio mentioned that it's down in Colombia. And how is this affecting the government-led, you know, electricity auctions, as well as other things like bilateral contracts and distributed generation?
Thank you, Lisa, and good afternoon to everyone participating, and also hoping everyone is well and safe. So we're already seeing some impacts already here in Brazil. Power demand in Brazil has already been decreasing due to the social distancing measurements that are already in place. So we have, like, schools are closed, commerce and non-essential industries are closing as well, and this is resulting in reduced commercial and industrial activity in the country, unemployment, and postponement of investments as well. So the pandemic is still in its beginnings here in the country, so it's very difficult to know exactly its impact on the economy. But I was looking at the most recent update from Brazil's central bank, and they already have revised the country's projected economic growth for 2020. So it was expected to be 2.2% of growth for 2020, and now the central bank is expecting minus 0.5% growth, so a negative growth, which will be mostly concentrated in the first in 3 months of the year here in the first semester of 2020, and some economic recuperation to take place in the second semester of the year. I was looking also today at the ONS, the Brazilian power operator, and the system operator, and power demand has already been reducing since March 19th. So depending on the day, I saw that there was a decrease in power demand between minus 2.5% some days and minus 17% other days. And also the ONS, the system operator, predicts that the fall in power demand for April this year will be around 8% and 6% in May. So the length and the depth of these reductions in power demand will define the impact of demand for new power projects here in the country. I was also looking at the Ministry of Energy's new information, and they also have revised their projections. So this week, they revised projections that energy demand growth for the country for 2020 will reduce from, they were expecting a growth of 2.3% in the year, and now they revised to 0%. And then power growth demand for 2021, they were expecting a growth of 2.8% in the year, and then now they're expecting 2.3% growth in 2021. So we're already seeing some revisions in projections of growth, official ones from the government. Also, an important event this week was that upcoming power generation and transmission auctions they were planned and announced to take place this year. They already have been postponed indefinitely now. This was announced this week. So we're supposed to have like in April an A-5 and an A-4 for existing energy. In May, we're supposed to have an A-4 for new energy. In July, we're expected to have a transmission auction. In September, an A-6 for new energy. In December 2020, a transmission auction. And in 2020, with no month defined, it was expected to be an isolated systems auction. These have all been indefinitely postponed. And this is a very important development because these annual auctions, they usually contract anything between, I don't know, like 2.5 to 4 gigawatts of solar and wind new installed capacity every year. So this is an important development. I've also been reading and talking to people that some free market contracts are already being renegotiated, but the representativeness of these renegotiations are still to be understood. So nonetheless, with the reduction in industrial and commercial activities, operations in the country, some of these energy consumers also should have excess contracted energy. And this could potentially lead to renegotiation. So just to give you an example, like a recent study that we published in January, that we mapped like 2.5 gigawatts of solar, just solar PV PPAs in the free market, and they have not started construction yet. So this is a question of how this will move forward. Another impact related to this excess energy in the market due to decreased power demand is a potential decrease in spot power prices in the country. I could say that this is already visible. If you compare spot prices here in February and then in March, they have gone down significantly. But then it could be also because we've been having a lot of rains and we have a big hydro matrix, so this could be that as well, so still to see. On the other hand, residential demand for power has gone up, not down, as everyone is staying at home. Distributed generation, demand has been going down. We've been hearing from some important players. Some DG equipment distribution companies that distributed generation equipment have reported reductions in sales, some between 10 and other 45%. So this could be important. Nonetheless, the government has announced a rescue plan for the economy as a whole, not specifically for renewable energy, and it represents around 5% of the country's GDP to fuel the economy. But the medium and long-term economic impacts of the crisis and globally and in Brazil are still to be understood.
Well, I mean, based on what you said about auctions, auctions have been the main tool for many Latin American countries to add non-conventional or non-large hydro renewable energy sources. Already before this crisis, we were seeing some countries delaying or putting off new auctions like Mexico and Argentina. So I would think that we're going to see this trend in other countries. I mean, if Brazil isn't holding an auction, others probably won't, and it probably will have an effect on the increase in non-conventional renewable energy, which really had been used to meet increases in demand, not so much displace, existing generations. So I think what you're saying probably, is definitely going to apply to other countries as well. And what about some of the global trends that are occurring as a result of coronavirus and how they are affecting renewables in Brazil? So we mentioned, the supply chain disruptions. I mentioned in the beginning how we're seeing generally, capital flight from emerging markets. Are these kinds of things impacting the renewables and power sector in Brazil?
Yes, as I mentioned, like power demand has been reducing in most, if not all countries, like globally. I was reading that in Italy, the power demand decrease was 16%, in the UK, like more than 10%. So definitely this will impact demand for new renewable energy projects in the short term. In terms of supply chain disruptions, what I'm hearing from people here is that these happened in China last month that were felt here in the country. They impacted delivery of components for renewable energy projects for about 2 weeks. However, the supply chain from China has already been restored. Not at full speed yet, but a lot of it has already been restored. But what happened is that now factories in Brazil some of them have also been closing due to the lockdown. So I was talking to one of the factory owners here for our PV panels here in Brazil, and the local government suggested that their factories close down, so they gave like 10 days of vacation, and then now 10 more days of vacation. So things are slowing down a bit. They don't know if the factory will be able to return to operation soon. They expect it to go back on the 10th of April, but not sure. But the larger impact has been on project construction, from what I'm hearing from people. Several project constructions have been stopping or at least slowing down due to the states asking for the lockdowns, and this will result in postponements for most projects under development and under construction. One very important and immediate impact of coronavirus crisis also has been the exchange rate here in Brazil. So, for example, like the exchange rate has gone from 3 to 1 to 5.2 to 1 US dollar from January to today. So it's a huge impact. And as most of the components of a PV project in Brazil, for example, are imported, then this has impacted the capex of these projects strongly already. This is very clear. The impact for wind is a bit less obvious here in Brazil because more components are produced locally. We have a more mature supply chain here in Brazil, but still being impacted. And global, this is a global thing. Like I was just reading that WoodMac cut its forecast for global wind installations this year by 6.5%, which means 4.9 gigawatts just for wind. You asked me because of investors, right? Investor flight, and in terms of investors, I would separate like investors on renewable energy in two different macro categories based on interviews that I've been conducting with some of our clients that we've been supporting and understanding the market here. And strategic investors, on the one hand, are the ones that are in these countries, in Brazil, for example, for the long term. Investments from these investors, they'll probably be postponed for maybe a few months, together with construction sites that are locked down and measurements that are being implemented by states of the country. But in the medium and long term, their plans is for investments to happen as planned and with some delays. An example that I gave, NO itself made an announcement that they expect to continue the investments as planned in renewables in the region. And then the second type of investor, then are financial investors that invest in renewable energy in the countries. Then the ones that are new, especially in Brazil, for example, or to renewable energy, they may be now reconsidering investments. They're at least waiting to understand what the impacts of this crisis will be on the economy and the market as a whole.
Okay.
Nonetheless, I wanted to also say that we still expect the PV industry, specifically the PV industry, to grow still this year in 2020 compared to 2019. And 2019 was a very strong growth year for PV. In Brazil alone, in 2019, were installed more than 2 gigawatts of new PV capacity, so 1.4 gigawatts alone from this solar DG, and 600 megawatts from utility scale projects. This represents around 9 or 10 billion reais in investments in 2019. And then to compare, in the first 3 months of 2020, there were installed at least 410 megawatts of solar DG projects and approximately 200 megawatts of solar utility scale projects. So this is adding up to more than 600 megawatts already installed this year. So this is 44% of what was installed in the 12 months of 2019. So also there is an expected regulatory change to take place here in distributed generation in Brazil, which will be implemented probably next year, by the beginning of next year. So there has been a rush, and there should continue to be a rush for projects installations this year to be able to benefit from the current net metering regulation in place. So this is a trend that's happening like opposite to the crisis, in an opposite direction to the crisis, right? Also an important driver for distributed generation.
Maybe just, we have a lot of questions from the audience, so I want to get a chance for some of those questions to be raised here. So thank you. There's just so much, you already have such a precise picture of what's going on. That's incredible. I think this is a question that potentially all of you might want to respond to. Will the impact of lower prices in production on public revenues lead to a relaxation of social and environmental standards and or a reduction of taxes to attract investment? So maybe Mauricio, we'll start with you.
Yes. So as soon as the coronavirus recedes a little bit, there'll be a conversation about how to stimulate the recovery, how to make sure that the economies go back to track as soon as possible. One component of that conversation, it's going to be stimulus to the oil and gas industry to make sure that the level of capex goes back to where it was planned before. Some countries have some mechanisms of introducing tax incentives, especially when prices are low. This is, for example, the case here in Colombia. So I wouldn't be surprised if we see some stimulus measures to make sure that oil investment comes back to where it was planned before the shock. That on the one hand. On the other hand, my take on the renewables. So the expansion of renewables is very solid. It's not just the case of Brazil. Colombia is another case in point. So those projects are long-term projects based on power demand, based also on incentives like specialized auctions just for renewable energy. So I don't think those projects will be reversed. And I would expect some slowdown this year because of the lockdown, and the lockdown means that the timelines of these projects are not going to be complied with. But after the lockdown is relaxed, I think those projects will continue. So I don't think this is really going to change the way in which Latin American countries are taking the climate change issue very seriously and also incentivizing renewable projects.
Mm-hmm. Jose, what do you think? Do you think social environmental standards will be relaxed?
Yeah, thank you. I tend to agree with Mauricio. I think the question is a very, very important question. To what degree does the impact of reduced prices in production generate a race to the bottom on those regulatory standards? And I can tell you, I think we're all getting accustomed to having 8, 9, or 10 video conferences a day. And of those conferences or those events, I would say that in my particular legal case, we're having a lot of discussion with environmental agencies, with regulatory bodies. And in all those discussions, in no instance has anybody referred to reduction or minimization of standards to a certain degree just to promote and improve the conditions surrounding potential investment. On the contrary, I think that because of the two factors being integrated in a simultaneous scenario, then there is a significant recognition that these standards are a must. That standards from an environmental, a social license to operate, prior public consultation, all of these aspects that are essential are going to continue regardless of these two situations. And if anything, they demonstrate that these are key factors in ensuring that projects are viable and feasible, not only from an economic perspective, but from a social perspective. So the way we see this is perfectly aligned. I think that the projects that were already there, particularly renewables, will continue, they will be delayed, etc. But agencies and regulatory agencies are working very strong to maintain these standards and understand that there has been an influx, there has been a change that has to also materialize into new regulations, which contrary to a race to the bottom, I think will stiffen certain requirements to ensure that we're being much more kosher with respect to what we're doing from an energy infrastructure and development perspective.
Okay, great, thank you. And Camila, do you think there will be changes to environmental and regulatory standards? And also, do you think overall, what's your sense of the impact of the low oil price on renewables, broadening the question a bit?
Mhm. I think I can't add too much to what has already been said by for the first question about the two by the two previous speakers. But in terms of like the impact of oil prices here in Brazil for renewables, which is the industry that I work in, here I don't see like oil prices looking so much as a driver for renewable energy investment in the country, specifically wind and solar for power, except for biofuels. In the biofuel sector, this could be it could become uncompetitive with very low gasoline prices, for example. So this sector could be impacted strongly. But solar and wind, we see very little fossil fuel for power generation, for example, here in Brazil, where the matrix is dominated by hydro and then followed by wind and then bioenergy. Another thing is that major oil companies are starting to become relevant in investments in renewable energy in the region. Here in Brazil, for example, we recently mapped in an M&A study for solar PV investments here in Brazil. And Total, Equinor, and BP, they have around 8% of the total signed PPAs in the regulated auctions in Brazil today. So they're relevant, but they're still not among the top 12 players in terms of market share. But they're growing in participation. This year, specifically in 2019, they grew significantly. However, I think the lower oil price will definitely have a more clear impact in renewable energy in other Latin American countries that rely on the use of fossil fuels for power generation, I think. And also, just to add, I heard a very good webinar by BlackRock's Larry Fink, and he said that in the short term, sustainability preoccupations could become secondary to the pandemic. So this could have an impact on renewable energy investments as well.
Mm-hmm. Right, and for those who don't know, in terms of what you were saying about the ethanol, I mean, in Brazil, the majority of drivers have flex fuel vehicles where they can just choose any day at the pump to switch from ethanol to gasoline. So a big drop in gasoline prices immediately hurts the ethanol industry, which is something that is unique to Brazil, you know, where it's such a big industry and you have such flexibility. And I have a question going back to Mauricio. What about the impact for consumers? You know, are we seeing, do you think we're, as I was mentioning about, ethanol in Brazil being affected, do you think that most consumers are going to benefit from the lower fuel prices? People can't really get out and make use of it, but how are governments adjusting in terms of pricing policy, and what does this mean for consumers?
Well, to a general extent, consumers will benefit. Maybe not now. Some countries have regulations that are slow, and the current prices, market prices, do not reflect what has happened with the oil prices. But with time, it will trickle down. So some countries have already reduced domestic gasoline prices. Well, that's the case of countries that use essentially a market mechanism. Well, in Chile, for example, in Peru as well. Colombia's domestic gasoline prices have fallen by about 10%. Brazil announced a reduction in natural gas prices. Not yet on gasoline prices, but this will happen. But this will happen at a time also when demand for refined products is reduced. I mean, refineries are basically reducing their level of production very significantly. Some refineries are probably going to be shut down. It's more economical to produce at full capacity in one refinery than have two refineries producing at 50% each. So this is something we're going to see because the storage capacity for fuels is very limited, and this is a common characteristic throughout the region. So we're seeing lower demand for fossil fuels at the time also when we're seeing lower prices. So we're not counting on lower oil, gasoline prices or fuel oil prices or diesel prices stimulating demand and creating problems from the point of view of carbon emissions. If anything, what we're going to see this year, and we're seeing already, is a reduction in carbon emissions, which is the risk for the climate change agenda, because this is just a temporary reduction in the consumption of fossil fuels. It shouldn't relax our concerns about climate change. And this brings me back to the point that some of the strategies that are in place in Latin America, especially in the power sector, do not really look at fossil fuel prices. It's more like an agenda on diversifying the energy metrics, and that's still going to go on into the future. Maybe the transportation sector, transition into electric vehicles, maybe that's going to be affected. But in the power sector, I don't see this as a major disruption in terms of the plans that the region has.
Right, and we don't know how long each of these crises will persist. So if the measures taken against coronavirus are eased much sooner than oil prices recover, we may see a much bigger influence on fuel demand in the countries with liberalized prices. But for now, we don't see that.
If I could add a little bit to that, the lockdowns in Latin America are not going to last for too long because of the economic pressures, given the amount of informality, the lack of social protection. People will demand some relaxation of these lockdown measures and the social distancing relatively soon, perhaps even earlier than before the curve of the pandemic flattens. So you'll see some recovery in terms of economic indicators in the not too distant future.
Right. And Jose, do you want to add anything on the issue of the downstream sector, what you're seeing?
Sure. I think that and I think it's one of the questions that somebody presented there on the chat that ties into something that I would not underestimate, and I think that governments and private parties have to assess carefully because of the situation, and that is, as Mauricio is saying, I tend to agree. In Latin America, the informality will push the relaxation of the lockdown. We're seeing this throughout the region. People need to go out and work. People live on a daily salary that they obtain on a daily basis, and that pressure will be significant and will continue to grow exponentially. So you have to balance both things. And what has to be assessed from a legal response perspective to the downstream, midstream, upstream scenario is you have to be able to understand that there will be litigation and there will be legal issues tied to the decisions themselves, right? Was it good for a government to say at a determined moment that a price for the transport of oil and gas was X and not Y? Was that satisfactory for the investors at a determined moment? Was the reduction in certain terms and conditions for prices for consumers acceptable vis-a-vis the upstream scenario? And as the economy starts to kick back in and reestablish itself, then people will look back at those decisions to say, are governments liable? Are decisions triggering liability? Was that force majeure from a contractual perspective to suspend a contractual obligation valid or not? So what we expect is right now we're sort of in this scenario where we're notifying all these situations and trying to react to them. But then sooner than later, we're going to be faced with the claims associated with all the negative backlash that nobody could have to a certain degree foreseen. So there's a very important complexity tied to these issues from that perspective.
Yeah, that's a huge issue as well. That's very interesting. Mauricio, you want to make a comment?
Yeah, well, I was looking at the chat and there are tons of questions.
Yes.
All of them very interesting. And I was hoping that I could answer it briefly, some of them that relate to sanctions in Venezuela and others that relate to the region. This is a broad question. Several of the participants are asking. The region needs large stimulus packages, fiscal costs, and we're going to be running larger fiscal deficits. What's going to happen afterwards? I mean, are the countries going to do the reforms that are necessary to improve the fiscal balances. For example, people are asking about the tax reform in Brazil. Will Minister Guedes succeed in pushing that agenda now in the context of these new economic realities? So if I can, I'll say a word about that.
You too.
Well, sanctions. Many people are asking for a relaxation of sanctions in the case of Venezuela because of coronavirus. And I think that makes a lot of sense. Allowing companies that produce the equipment, the ventilators, the kits for the tests, to supply Venezuela, and allow banks that basically participate in those transactions to do that without being exposed to the very severe sanctions that are in place. I think that makes a lot of sense. I think that's something that the Trump administration should do. Otherwise, what we're going to see is full lockdowns in Colombia, Ecuador, Peru, Chile. That will be ineffective if there is an exodus of Venezuelans that are basically that are affected by the coronavirus. So this is a global issue, and we should provide a solution to what's going on in Venezuela. I don't think this is going to make a big difference in terms of the capacity of the sanctions to produce the effect that the Trump administration wants, which is the change in regime. But we need to tackle the issue of the coronavirus in Venezuela very seriously. Number two, on reforms. Crises are opportunities, as always has been said, and it's an opportunity to do reform, especially if you combine the need of a large stimulus package, and this is what countries are doing, especially not the traditional stimulus of infrastructure or construction. It's more of the stimulus in the form of supporting families with additional income so that they can live during these days of the lockdown. This is going to generate more debt. This is going to cause trouble with the rating agencies. But the way to minimize that damage is to say, well, in addition to this, next year or the year after, there will be a phasing in of some of the reforms. In some countries, it's about pensions, like here in Colombia. In some countries, it's about taxes, like in Brazil, in Ecuador. So there has to be a combination of short-term stimulus and long-term reform.
Great. So it's almost one, but as Mauricio said, there are lots of interesting questions. I'm just going to quickly ask one more question to Camila and one more question to Jose that we have from the audience. So, and I'm sure all of you would have thoughts about this, but Camila, what are your thoughts about, a couple of people have asked about how stimulus packages can be used to benefit clean energy. That's something here in the US, there's a big discussion already. We had the concept of the Green New Deal. Now the Democratic Party is putting it into the stimulus package. Is that something that's being discussed, could be done, or should be done in Brazil? What do you think?
Lisa, there's nothing being discussed specifically for renewable energy here in terms of support for renewable energy due to the crisis. But we have heard from Paulo Guedes this package, this incentive package for the economy. So there's, for example, incentives for rollouts of debt, right? So you could postpone payments of BNDES debt with most of the projects here in Brazil. Wind, solar, for example, have financings in BNDES, for example, and BNB. They could be postponed for 3, I think, for up to 6 months, which is great. And they also announced some cash flow financings at subsidized costs for small and medium sized companies, and also some for large as well. So I think these are more economy-wide stimulus package, and not ones that are specific for renewable energy projects, but the renewable energy projects can also benefit from them. We were before the crisis going through a discussion of the reform of the Brazilian energy sector. And the discussion is actually to reduce some of the benefits that renewable energy projects have, like the discount and the TUSG and the TUSG, which is the transmission charges for renewable energy projects that we currently have for like 50% to be phased out. So I'm not seeing a discussion to increase these incentives, but to decrease, but incentives for the economy as a whole, and then renewables could benefit as well.
Right. Interesting. And Jose, there's a specific question about Ecuador, which we haven't talked about that much, and it may be something that applies to other countries. It says Ecuador's Ministry of Energy issued a decree making it almost impossible for companies to invoke force majeure. Do you expect it to be suspended by the courts? And I mean, is this something that you're seeing anywhere else in the region?
Thanks, Lisa. Oh, to that point very swiftly. Decree 1017 of 2020 in Ecuador, President Moreno issued a series of regulations tied to what is being indicated as a result of that general declaration under COVID-19. Our legal view is that the rule of law cannot, vis-a-vis the court, in a system where there are checks and balances, define that something is not force majeure upon the occurrence of the force majeure event. So our view is, from a legal standpoint, that it will be up to the courts to decide, and you cannot simply tell everybody, forget about this being a force majeure, it's knocked down, without considering all the precedent and case law that's out there, not only from a local perspective, but also from an international investment perspective and from an international case law perspective. So I would say that does not apply the way it is being attempted to apply. I understand the theory behind it, but clearly in systems where there are democracies and there are courts, the courts will have a final say with respect to what was and what was not force majeure in a specific case. Thanks.
Okay, interesting. Well, as Mauricio, I just wanted to really quick ask if you had any comments about this green stimulus idea, because I thought it would be important to have your perspective as a former finance and energy minister as well. Do you have any thoughts about whether that could be done in Colombia or elsewhere, or should be done?
Yeah, in all frankness, it's not what governments are thinking now. They have other priorities. They're, of course, very concerned about the economic contraction, the loss of income at the household level. So most of the fiscal stimulus is going to be directed to households and to companies that are going through, difficulties in paying their debts, in paying their payrolls. That's going to be, I guess, for the first few months of this crisis, the focus. Maybe in the next phase, when the economic stimulus measures in a more broad sense come into place, maybe there's space for fiscal stimulus that looks more green. Mm-hmm. But not now, in all frankness. I would like to say something else, maybe that connects to this, because how long are we going to see these very low oil prices? This is a crucial question for these governments to design the fiscal response, because if we're going to have less money this year, but next year we're going to go back to normal, well, it's much easier. And it's much easier also to explain that to investors and to rating agencies. But unfortunately, I don't think that's the case. I think we have to be prepared for a new normal of low oil prices for a long time. I think with the failure of OPEC Plus to cut production, we're entering a new stage with increases in supply, with a relatively weak demand. The demand is going to remain low, and I don't think this was something that was done that the Russians and the Saudis precipitated in an irrational way. I think there is a lot of logic behind the decision. I think there is a short-term pain for every oil producer, but for them, for the major producers, especially for Saudi Arabia, there is a long-term gain in the sense that it will allow Saudi Arabia and Russia to reach two goals. One is the taming of shale oil, and two is to bring the U.S. on the side of the interests of oil producers. Remember, the U.S. before this was ambivalent between consumption and production, between importer and exporter. Now it's clear that for the U.S. economy, the interests are much more aligned with the interests of the oil producers. So this could potentially become the beginning of a new institutional world arrangement, which is, the Texas Railroad Commission working with OPEC in the same direction. But this will take some time to mature and to materialize.
Mm-hmm. Yeah, and I think, back to your point about whether green stimulus is a priority, I mean, I do think it's a concern that the climate change agenda, if to the extent that it's seen as implying higher costs, could become, you know, even lower on the list of priorities. I think that's a concern. Well, unfortunately, we're out of time. This has been really interesting. I let it go over a little bit because I really wanted to ask a couple more questions. We didn't get to all of them, but there was a question in the chat about whether we'd be writing a summary, and we actually do publish summaries of our events a couple days later on our website, so you can check that out. And I really want to thank all three of you for your excellent comments, really insightful, great to have these different perspectives. So thank you so much, everyone.
Thank you.
Thank you.
Thanks a lot.